Hello, my name is Aya Yoshioka, and I'm a portfolio consulting director and senior investment strategist here at Wealth Enhancement. Welcome to what we call our 7 Market Mover series, in which we talk about global economic growth, interest rates, monetary policy, inflation, and other topics. However, this week we're really down to one market mover, and that has been tariffs. So on Wednesday, April 2nd, President Trump announced reciprocal tariffs that were much larger and much more far reaching than most had expected. A minimum 10% tariff has been assessed to all exporters to the United States, and additional duties were assessed on many countries that have the largest trade imbalances with the United States, including countries such as China, Vietnam, Japan, and the European Union. So, how are these tariffs impacting our 7 market movers? Let's start with global economic growth. Global trade norms have really been upended here with these tariffs, and this uncertainty is rippling through multiple economies. It will show up in upcoming economic data and upcoming quarterly earnings season commentary. And we're likely to see equity market volatility remain high, both on the upside and on the downside, as we may get additional headlines that may reverse some of these tariffs. Well, we saw today also in economic data the March ISM number, which remained above 50, which indicates the economy remains in expansionary territory, but it did downshift from last month. And that has been the concern that we will continue to see a potential downshift in economic growth. As it relates to inflation, these tariffs are expected to manifest in a wide variety of price increases across a wide variety of goods. And this is reigniting inflation concerns. The final impact of these tariffs will depend on whether or not other countries enact their own reciprocal tariffs, and how much US companies decide to pass on these additional costs to their customers. Interest rates and monetary policy, in terms of those topics, markets are still predicting that the Fed is actually not likely to move at the upcoming May 7th meeting. And that's because, inflation remains a concern. The Fed doesn't want to ease into that. However, just given the softness that we are expecting in terms of economic growth, we are likely to potentially see, or at least the market is expecting, a rate cut at the June meeting. In the meantime, we will get additional economic data, and that will include tomorrow's jobs report. The non-farm payroll report could be weaker than expected, and that could lead to additional equity market volatility, and bonds could continue to rally more. Today, we did see unemployment claims, and the weekly continuing claims were worse than expected, while the initial claims weren't that bad. This really indicates a job market in which we're not seeing significant layoffs, at least not yet. But if you are laid off, it is becoming difficult to find a new job. Let's talk about investor sentiment, and that has been reflected in just sort of the market action that we saw today. Today, on Thursday, April 3rd, the S&P was down over 4.8%. Small caps were down 6.3%. The European stocks were down 3.6%. Japan was down 2.8%. And so there was really no place to hide. Even in commodities, oil was down 7%, and gold, which had been a safe haven, was down 1.3%. Fixed income was your ballast. Treasury yields went down. The 2-year saw Treasury yields come down 15 basis points and is now yielding 3.7%, while the 10-year is down to about 4% here. And so bonds really did provide some ballast to portfolios. With that being said, we do believe that investors in high quality, globally diversified, and balanced portfolios should stay the course here. despite the potential for additional volatility. Timing the market is a nearly impossible task. And during bouts of high uncertainty, we may inadvertently miss eventual reversals in markets. Thank you for listening to me today, and we hope to continue to provide these updates to you in a timely fashion. And we understand that this volatility can be very unnerving. But if you have any questions, please reach out to your financial advisor or to our investment management team. Thank you so much and have a great day.